Types of hybrid mutual fund or balanced mutual fund. Debt-oriented hybrid/conservative funds, debt 75% to 90%, equity 10% to 25%. Debt-oriented hybrids invest a minimum of 75% to 95% in a debt portfolio. The debt component is conservatively managed with a focus on generating regular income, which is generally paid out in the form of regular dividends. The credit risk and interest rate risk are taken care of by investing in liquid, high credit rating, and short-term debt securities. The allocation to equity is kept low and primarily in large-cap stocks. To enable a small increase in return, these funds are taxed like debt funds. Aggressive hybrid funds, debt 20% to 35%, equity 65% to 80%. Predominantly equity-oriented hybrids invest in the equity market but invest up to 35% in debt so that some income is also generated and there is stability to the returns from the fund. Balanced funds are designed as equity-oriented funds. Balanced funds are suitable to those investors who seek the growth opportunity in equity investment, but do not have a very high-risk appetite. Balanced funds typically have an asset allocation of 65 to 80% in equity, and 20 to 35% in debt. They are taxed and treated as equity funds and to this always maintain at least a 65% exposure to equity markets. Dynamic asset allocation funds invest in both equity and debt but without a pre-specified allocation as in the case of other hybrid funds. The fund manager takes a view on which type of investment is expected to do well and will tilt the allocation towards either asset class. Such funds can even hold 100% in equity or debt. Multi-asset allocation funds. These types of funds invest in different asset classes like equity, debt, and commodity, like gold. At least 10% allocation in each asset class. Arbitrage funds. An arbitrage fund is a type of mutual fund that leverages the price differential in the cash and derivatives market to generate returns. The returns are dependent on the volatility of the asset. Capital protection funds are closed-end hybrids funds. In these types of funds, exposure to equity is typically taken through the equity derivatives market. The portfolio is structured such that a portion of the principal amount is invested in debt instruments so that it grows to the principal amount over the term of the fund. This provides protection to the capital invested. The remaining portion of the original amount is invested in equity derivatives to earn higher returns. Mutual funds are subject to underlying risk. Please read all documents carefully before investing.